Welcome to Tea at Taxevity, where you get insights from insiders who make life better, our many clients and friends. My name is Pramod Sharma, and our guest today is Ross Morton, who is an advisor to the insurance industry. Welcome, Ross.
Thank you, Pramod. Good to be here.
Well, it's great to have you here. In a sentence or two, what do you do?
Today, a lot of my time is taken up basically being an advisor to the industry, whether it's on a complicated claim or I'm asked to do an expert opinion, give a lot of speeches, mainly in North America and the Caribbean. So I give advice to various people in the insurance industry, and I do a little bit of work for Santa Claus, but we can leave that for later.
Yes, our topic today is from risk to Santa Claus, and the two are related.
Absolutely.
Now, could you please tell us what reinsurance is?
Reinsurance is basically someone is taking the excess risk from an insurance company. So in a way, a reinsurer is the insurer's insurer. A reinsurer plays a role in that it helps the company write a larger risk than it normally would by taking the excess risk over what a company feels comfortable with accepting.
Mm-hmm. And most people probably didn't know that there were reinsurers behind the scenes. Now, would a policy holder know who a reinsurer is or know about reinsurers?
No, there's no real need. In Canada, we're very fortunate in Canada. We've never had a reinsurance failure. We've never had the government to step in to bail out a reinsurer. The insured, or the individual consumer of an insurance product has a contract with the insurance company.
Mm-hmm.
The insurance company has a contract with the reinsurer.
Mm-hmm.
There is no relationship between the reinsurer and the insured, the consumer. In Canada, you're lucky you don't really need to worry about the reinsurance, who's being used as a reinsurer. They're all licensed, they all keep their reserves in Canada, so there's no real need. If it comes up, it would possibly be on an extremely large case. Once a year it might come up where the consumer is so large, putting in so much money, they would like to know a little bit more about security.
Mm-hmm.
That's rare, very rare.
Now, back in the days when I was designing insurance products, then dealing with reinsurers was one of my responsibilities, negotiations and treaty terms and those sorts of things. And so I know the answer to the next question, but our viewers may not. Is reinsurance free?
Absolutely not. Reinsurers, even when we had a lot of mutual companies, the reinsurers were all stock companies. They had to make money. They make money on basically mortality gains, and hopefully they don't have losses. No, they have to make money. What they charge is what's basically we would call a mortality charge or a morbidity charge. They're not in the investment field. They don't handle the assets, etc. They're not making money there. They're making it purely on mortality. And so what they're passing on is the cost of mortality, in other words, the prediction of how many people would die at a certain rate over a period of time, plus their expenses. They don't have the same expenses as an insurer in that they're not administering the policy with the public. They're not handling investments, etc. So pure mortality or morbidity charge.
Right. So it's almost like term insurance that the insurance companies are buying.
Absolutely.
Where they pay premiums that could potentially vary every year.
In fact, we call it yearly renewable term premium.
Mm-hmm.
So that's what it is. It's a premium that basically fluctuates every year.
Okay, now insurance companies are large. They're multi-billion-dollar institutions. They're in the business of insurance. That's what they do. Why would they want to go to a reinsurer?
Well, they didn't. At one time they didn't. When I started in the business 45 years ago, 0.4% of all life risk in Canada was reinsured. Reinsurance was tough, and yet we had 9 reinsurers fighting for that 0.4%, and we fought tooth and nail through the 70s. Companies kept as much mortality and as much morbidity risk as possible. The boards at that time were often made up of sometimes an ex-advisor, agent,
Mm-hmm.
often made up of a previous CMO, chief medical officer, who was on the board.
Mm-hmm.
So they understood risk and they kept the risk themselves.
Because the risk was profitable, and then why would you want to give those profits to someone else?
And that's the way the actuary said, I want to keep as much as I can. I'm going to retain as much as I can of every risk.
Mm-hmm.
We're always looking for a way to increase the retention. And then it changed. The reinsurance price became so attractive that the pricing actuary decided to reinsure more. So in Canada, we're today about 74% of all life risk is reinsured.
Oh, it's that high.
It's that high.
Okay.
versus the United States, which is only about 18% of all risk, life risk is reinsured.
Okay, and what would the difference be between the two countries?
Um, I think it's the risk-taking sort of mantra. In the United States, I think a lot of your boards of directors of your large and small insurance companies understand risk. They understand they are insurance companies and therefore they should be in the insurance business. Therefore, they understand you can make money on mortality. Mortality has, over decades, constantly improved.
Mm-hmm.
And if you price your product right, do the right risk selection, you can make money at it, as everyone has shown over
Mm-hmm.
the years. So there's more tolerance for risk, more understanding of what life insurance is. I think in Canada, our boards of directors, in my opinion, are made up more of asset managers. They're in the financial services business. We tend to refer to ourselves as financial companies, not
Yes.
life insurance
Mm-hmm.
companies. Life insurance almost has fallen out of disfavor. I'm not a life insurance agent. I am a financial advisor. And
Yes.
at the company level, it's the same thing. I'm a financial institution. I like to manage assets. And risk, boy, my board of directors is made up of asset manager background people, not risk takers.
Okay.
That's my opinion.
Okay, and that's good for the reinsurers because
Absolutely.
more business.
You look at the reinsurers in Canada, they've done exceedingly well. They control 74% of all the risk.
Now, how is it that a reinsurer could have lower rates for mortality than an insurance company?
Well, for example, if I have 1,000 60-year-old males,
Mm-hmm.
I can expect certain results. But because I've only got 1,000, more could die in a year than I anticipated. And I could have a
Okay.
fluctuation. Whereas if I have 100,000 60-year-olds insured, I virtually have no fluctuation. I can almost
Mm-hmm.
guarantee you how many will die per year because I've got the mass numbers to give me the results I want. Reinsurers basically have grown to the point where they have 74% of all the risks. So
Mm-hmm.
you could say 74% of all 60-year-old males in Canada are reinsured.
Mm-hmm.
And with one of three companies basically, and their risk then basically has no fluctuation.
Right, because when I was designing products, one of the things that we'd be told is we should only keep as much insurance ourselves as our president would be comfortable with. So if we had a $10 million death claim, you wouldn't necessarily want to go to the president and say, well, guess what? This claim cost us 10 million. But if you went in and you said it cost us 1 million or 500,000 or whatever the amount was, then that was much more palatable because we couldn't deal, well, we could deal with fluctuations, we couldn't deal with them as well as a reinsurer would be able to.
No, and for a company, depending on your size, a $10 million claim, yes, you could pay it, you'd have the money to pay that claim,
Mhm.
but it could mean that you have to restrict your sales for the balance of the year. Because
Yes.
you're basically used up all your money to pay a claim versus using your money to expand. So a large claim of a magnitude of 10 million, wow, that could really hamper you. So you reinsured it. It was much more palatable to have a claim of 500,000, no, a reinsurer took the 9.5 million.
Hmm. And then another advantage was that when the cases were larger, the reinsurer would often look at those cases also. So it was another set of eyes on that case. Because even a $500,000 claim is money that, and you want to make sure that that's a legitimate policy before, like an acceptable risk before issuing it.
Absolutely. A reinsurer would, $10 million case might see one a week
Mm-hmm.
in their underwriting process and become very comfortable with what do I have to do to handle properly a $10 million case. Whereas an insurance company might get one $10 million case a year.
Hmm.
An underwriter may never have handled something that large and could possibly make mistakes. So a second set of eyes was phenomenal, especially experienced eyes.
Yes. Now, you've had the opportunity to look at the insurance industry over a period of decades, and that gives you valuable perspectives. So let's talk about how products have changed since the 70s and 80s. So we'll look at several different areas. What about margins in products? Are margins bigger now than they used to be? Are they smaller? What effects has that had?
Well, margins, when I started the business in January 1970, the margins were very fat. And you could say back then, actuaries tended to look backwards only and looked at experience that was, so in 1970 they would look experience from the 40s and 50s. Didn't want to get too aggressive and look at the 60s. The 40s and 50s were safe, and they would say, okay, here's the mortality trends, here's what was happening. So looking backwards, I can now tell you how the rate of death, the rate of sickness. So I'm going to use those prices. So there was lots of margin because mortality, even in spite of looking backwards, you knew mortality was getting better. The world was getting better. Our healthcare was getting better. But it was still safer to look backwards and be very comfortable and almost be able to guarantee profits and death rates. So you fast forward to today, and actuaries tend to look backwards to some degree, but most are looking forward, saying, okay, our mortality has improved 2% per year. So I'm going to build a price that's based on current statistics right up to today, and I'm going to assume going forward they improve by 2% a year forever. So that's a big change, but that also then strips out any margin. You no longer have anything left. In other words, if you have problems with your mortality, there's nothing there to bail you out. So there's that. Expenses, we used to make a room for a lot of expenses and fluctuation in expenses, how to handle products. To manage on the expense side, to manage a price, to administer business was easy. It was par, it was set up, or it was a term insurance, very easy. I had X dollars to manage that, to administer that over decades. Today, though, a lot of companies use those same assumptions for administration, yet the administration is more complicated. People have universal life where they could be phoning you up monthly and change my investment from high risk to low risk, to middle risk. I want it in the bond market, I want it in a GIC. Far more expensive to administer, which a lot of companies didn't account for. So the margins have been stripped almost in every area. And that's the biggest change.
Because I remember in the 1990s that if we had a particular case of interest, and I could phone the reinsurer and say, can you make an exception on this case, and can we take it at standard rates rather than have a rating, and here's some good reasons why we should do that. And the answer would often be yes. And then in the 2000s you'd make that same sort of request, and then the answer would be no, and then at some point you just stop making the calls.
I agree. I mean, I was called many times as a reinsurer, and the insurance company risk taker, leader, vice president, whatever their title, would say, Ross, we have a risk here. It's $1 million. We're assessing it at about plus 50 extra premium, plus 75, but we want to take it standard. We feel this is a very good life agent. Persistency is excellent, has always brought us very good business, very forthright person. We really want to take it standard, and we're willing to take half the risk. Would you take the other half?
Right.
And they had the margins to do that. They knew that by doing the odd exceptions when it was warranted, they could afford it. As a reinsurer, I had the same margins built into my costs, and I would follow them. And absolutely, say yes, I wouldn't even have to look at the evidence because I could trust them, and we're splitting the risk.
And we wouldn't call on every case. It would be a very special case.
It was truly an exception.
Yes.
It was truly an exception, and you knew that. It wasn't like every day someone's phoning you. You fast forward to today, and more likely the call is along the lines of, I don't want any of this risk, I don't like it, and I don't know the advisor, because we now deal with advisor maybe once a year in a brokerage world, not a captive career force. So I don't want any. Would you take it? Would you waive the two tables? Would you waive the plus 50 and take it? And my answer is no, thank you. If you don't take any of the risk, if you're not willing to bend and you don't feel there's any margins, then I certainly don't have them as a reinsurer.
Right, because before, the insurance company and the reinsurer would be sharing in the risk, and that was called coinsurance. And in the latter 90s, or I think roughly around that time, that started to disappear. And then we had a different kind of reinsurance.
Yeah, we did. Now, part of it was coinsurance became crazy.
Oh, because I only saw it from my view as a product actuary. But okay, from the reinsurer side, there were some issues.
It got crazy. Let's say I assume I would take the premium you were charging, and I would take that premium as being adequate, but then I'd have to pay you a commission because you have costs. You have administration, underwriting costs that I don't have. You have a commission to pay. You have a marketing team to pay. So you would give me $1, for example, and I might give you back $1.50. The extra 50 was to pay for your first year cost. And I would know that in my premium over time, I'm going to get that back because it was
Okay.
coinsurance. Just like you spent more than the dollar you took in, you would get it back. So
Mhm.
yes, we were in the same boat, we were sharing it.
Right.
We both invested today in the business. But reinsurance became so competitive. And remember, that was an era where there were still 9 reinsurers fighting for every penny. We still hadn't reached the 70%
Okay.
plus. I wanted the business. So instead of 150%, I might get, in some cases, got up to 250%. It was a
Okay.
different time. You didn't need 250, but I was so desperate. Now, when I paid you 250%, this business had to stay in force not just 7 years for me to break even, maybe 14 years.
Okay.
Okay, it got crazy. And it actually got to the point in the United States where one company became so addicted to the extra coinsurance that they started a department, a confidential department where people went through the phone book and made up policies. Because I was sending you $1, but I was getting back $2.50.
Oh.
And on phony people that never really had insurance.
Oh.
And that was basically a California scheme. It was very famous, and it went on until an actuary one day couldn't live with himself and blew the whistle. Very famous case where finally, after a couple of years, but in that case, every reinsurer, and there were 6, I think, involved 7, every reinsurer got hurt badly because it was
Right.
paying more. Now, I always like to say that we were the only reinsurer smart enough to not take any of that business, but I have to be honest, the only reason we didn't get the business is we didn't have our California license yet. Otherwise, we would have been taken for a ride too.
Right. So it seemed until the 1990s that the insurance companies and the reinsurers were working as partners. And then as we shifted away from coinsurance, the industry seemed to become more of just a commodity, a business transaction.
Yeah,
Is that fair?
Yeah, it became a commodity. Basically, lowest price wins. YRT, very simple to analyze. One price versus another. Here's what we're going to have to pay you to take the risk. So it became very comfortable for the companies to just farm it out. Best price wins, and all the attachments or the accoutrements that were attached to the old reinsurance, like education, underwriting seminars, actuarial seminars. Help with marketing, etc., visitations, that all basically got cut down or disappeared totally, and it's down to a commodity that you buy.
Right, because I remember
the word partnership disappeared.
Because I remember that I would be able to go to my boss and the president saying that, okay, the offer from reinsurer A is not as good as reinsurer B in dollars, but reinsurer A is providing these additional services, etc. And then we might still go with them. But then later on it would be, okay, just tell me who the cheapest is.
Yeah.
These extra things don't really matter. And then maybe that was the reason the reinsurers had to stop doing them, because it just wasn't being valued by the companies.
Yeah, even some of the surveys, if you did a survey, surveys that were done in the 80s, 90s, how valuable was facultative underwriting support? So this is support on that problem case where an insurance company had somebody with a complicated medical history and they wanted a second opinion, hopefully a better price from a reinsurer. How that was very important. That was viewed, almost 90% of underwriters, risk takers would say, that's very important to me. That's an important feature of who I do business with. Today, it's about 15% of underwriters say it's important. So it really has changed.
Right. Another change that's happened over the decades is that the biggest insurance companies used to be mutual companies, which meant that they were owned by their policyholders. And then they've shifted over to stock companies. Has that had effects on the market?
In my opinion, it has. When you switch from a mutual company, and I only worked for one briefly in my career, but I'll go back to my start of my career. My first president, Ian Mickey, a Scotch Presbyterian actuary, very set in his ways, but someone that was probably a great person to work for early in your career. His advice was, the work you're doing today benefits people 40 years from now. Good mortality, bad mortality, it's going to influence 40 years from now. The fact that you did it right and the company stayed in business meant people would benefit. You go, and that was sort of the mutual, what I saw as an outsider reinsurer, mutuals operated that way. It was one for all for one. It was truly a mutual. It was like a collective. It was, everybody benefits. The consumer benefits, staff do well. Once you go to a stock company, and I saw it, so I had to make the transition in a company from worrying about the long-term future, the viability of a company, to all of a sudden I'm being told, you worry about the next quarter.
Yes, that was
We
tough.
got to make our next quarter's objectives, even though it might impact the quarter after that. Let's worry about this one. We'll find a way to massage that one when we get there. It became very short term. I came from a period when companies did 5-year plans, and now basically it seems like companies do 1-year plans. It's all about this year. I can't remember the last time I heard of anyone talking about a 5-year plan.
Right,
It's
yeah.
ancient history.
The whole industry has changed that way, and I'm not sure that it's necessarily a change for the better, but change is change.
Yeah, it's the reality of basically conglomerates in the corporate world today. It is all about making money if you can.
When I was studying for my actuarial exams, we had to study things about reinsurance, and one phrase kept occurring. It was called a gentleman's agreement, that reinsurance was a gentleman's agreement. And this wasn't meant to be sexist, but it just meant that you could have a handshake and that would be a valid agreement. Do you recall, like, so? And then I found it when I was working that actually happened in practice. Like, can you just give us some background on these gentlemen's agreements?
Oh, absolutely. I mean, in Canada, you can go back when I was looking and writing a paper on the history of reinsurance, many, many years ago. I came across a couple of letters, and they were basically a one-page letter, big bold print on an old typewriter, 1896, and it was from Temperance and Union. The old Manulife was called, I think it was Temperance in General, and it was to North American Life at the time. And basically, it was one president saying, "We're going to give you this reinsurance. We're glad you agree." And the answer back was yes. One page. Here's what we're going to give you. Yes, we'll take it. But before that, and that might have been signed months after, there was a handshake.
Right.
Even if you had a claim the next day, it was paid. It was truly was a handshake. Even when I started in 1970, I was taught it's a gentleman's agreement. It's a handshake. Ross, when you go out and you agree to something and you shake the hand, we have a deal. Many times we would never have a contract ever.
Really?
It was
Okay.
there were many large deals that we would do where, who needs it? You haven't got time to do. Don't worry about it. Both sides, we wouldn't worry about it because, from what I had shook your hand,
That meant something. Yes.
I had agreed to whenever you took 100,000, I would match it and take 500,000. It was agreed. The price was X. It was agreed. The fact that we didn't formalize it was okay. There was always the umbrella agreement, the 38 coinsurance agreement, the 59, the 65. There was always an industry agreement on how the principles of reinsurance were. So I never felt I needed the contract. Whereas today the contract is handed over to a lawyer and it's 150 pages. And I always believe the thicker you make the agreement, the more holes you could find in it. And lawyers are very good at finding holes.
Yes, because I recall that I'd be able to phone a reinsurer saying, "Hey, can you do such and such?" And then that phone call would be enough. And they'd say, "Okay, just send me an email."
Yes.
So it could be documented later on, and that would be fine. And then later on, we'd be getting reinsurance quotes, etc., and they would say certain things, and then we'd have to read every single word in the contract to make sure that what we agreed to in the summary was actually in the contract. And sometimes, wait a second, I thought we agreed to such and such. Oh, we forgot to put that in. And you never knew whether they really forgot or whether that was a way to transfer more profits to them. It became very businesslike, very contractual.
Very contractual. And again, like I said, the lawyers got involved. I mean, throughout the 70s, even early 80s, a lawyer never saw the contract. I mean, we never hired a lawyer as a consultant or an advisor. We did it ourselves, or we relied without one. Once you had a lawyer looking at it, they would point out all the ways to get around it. And I remember one of the famous deals in Canada that went awry when one reinsurer won the business, and they assumed they were going to assume all business that was underwritten and approved on July 1st. The reinsurer who used to have the treaty termination was worded that the reinsurance treaty would terminate on all business where the risk was approved and issued by June 1st. So there was a gap of no reinsurance. That wasn't the intention.
Right.
The reinsurer that was assuming the business assumed it would get it as soon as they ended it, and the sooner the better.
Yes.
So there was a bad claim. There was an early claim in that period.
Right.
As a reinsurer, we said we'll take it. There was no question. We corrected the fundamental error, which everybody knew wasn't the case. I don't believe that would happen today. There'd be a huge argument over whose risk was this.
Yeah, just imagine going to your boss saying that, well, there was this gap, but the right thing to do was to pay it. Then I don't know if your boss would be very happy.
No, and it hit me personally. I remember a very small case. I think total was about 50,000, of which as a reinsurer we only had 40,000 of it. The ceding company had 10,000. It was a small risk. The person died early within the contestable period, but the insurance company said we don't want to pay it. Or sorry, the insurance company said we want to pay it. This is a good agent, known him a long time. It's a small case. We have a lot of the other family insured. We're going to pay it. Well, that's a pro bono payment. That's an ex gratia payment. That's not a contractual payment. We told the insurance company, you can go ahead and pay it, but it has nothing to do with us.
Okay.
If that was 1971, I would have paid my 40,000.
Right.
I would have had the margins to afford to do it. But in this day and age, I could never afford to throw away $40,000 just to win a friend.
Right.
Just alien concept.
Now we're talking about from risk to Santa Claus.
Yes.
And you gave me your business card. It looks like this. Now, would you mind explaining what you do when you're not helping the insurance industry?
I work for Santa Claus.
Oh, okay.
Yeah, 23 years ago, Ron Barbaro, probably, one of the most famous insurance people that Canada's ever produced, and a fellow by the name of Ross Johnson, who was my president. We both know Ross.
Yeah, he used to be the president of National Life, where I worked.
And then Prudential.
Yes, that's right.
Well, the two of them had been, Ron I had met in the 70s when he was an insurance agent, and Ross Johnson I had met probably in the 80s. And they came after me and said, we would like you to be a celebrity clown. Now, the Celebrity Clowns is a group of about 150 men and women who start the parade. We all pay $1,200 to be a clown.
Okay.
And that helps fund, it's a charitable donation, helps fund the Santa Claus Parade, which gets no money from governments, etc. So these two said, we want you to be a celebrity clown, Ross. You should be a celebrity clown. And both of them having agency background, life insurance sales background, they're very persistent.
Okay.
And they wouldn't take no for an answer. And I finally one day said, I'll do it once. I'm going to be a clown once on the promise you won't bug me afterwards when I don't come back.
Okay.
Both of them, Ross and Ron said, fine.
That almost sounds like a puppy dog close. Just try it out.
Just try it. Being a clown, I'd never ever thought of myself as being a clown, but I loved it. And that's 23 years ago. So I've been a clown for 23 years. 3 years ago, I was asked to go on the board of directors of Santa Claus Parade, and now I'm also on the board, and I'm executive vice president of the parade. So It is a full-time job. Well, it's a full-time in that it goes all year, but it doesn't take up all my time, but I love it. I'm paid in smiles. Santa pays me lots of smiles. If you walk 6.25 miles with 700,000 people along the streets of Toronto, it is so rewarding. I remember when Neil Skelding did it first. I wasn't sure if Neil Skelding, who's the president of Life Operations Worldwide for RBC, he was a clown for 6 years.
Okay.
But he did it again. I was persistent after him, and he finally said yes, and he did it for 6 years, and he did it with his children. To see him transform from this very serious president of a major life operation globally to a clown, just the minute he got the costume on and the makeup done by makeup artists and hit the street, he became a clown. And he loved it. And again, it was a day when nobody knew he was Neil Skelding, president of RBC.
Right.
He was just a clown out to make kids smile. And that's the transformation that happens. You can take almost anybody, put them into costume for a day. Nobody knew it was George Jewison when he was a clown. Nobody knew Rick Vibe. Nobody knew Ron Barbaro. We're all just clowns.
Right.
Men and women who walk the parade route with a total goal of bringing smiles to little kids and their parents.
And I think you were saying before we started recording that you spend maybe half your year working on the parade?
Yeah, it's about half. It starts basically, it's 12 months because once the parade finishes, then we have to find 23 sponsors. Each sponsor's $50,000 to sponsor a float. We have mini floats, we have push carts. So we have to raise $2 million to put it on. We get no funding from municipal, provincial, or federal. None.
Okay.
Okay, so we have to raise it to put it on. It's been 33 years since Eaton's walked away from the parade, and 33 years since a bunch of gentlemen in Toronto stood up, and they were gentlemen at the time. Now it's gentlemen and gentlewomen who basically keep the parade going. A lot of fun.
And there are advantages to having the Toronto Santa Claus Parade. This is a photo of my son many years ago at an event at National Life, and what he used to say is that he understood that the Santa Claus in the malls, that was just a helper, but this Santa Claus was the real one. And I gather we were able to get the real Santa Claus because you had those kinds of connections, and do appreciate your help with that.
No, I mean, our Santa Claus is the real Santa Claus, and he does help with other functions, and he plays a big role. I mean, it's the start of the holiday season. It's the start of a nice time in Toronto, and it is an iconic. This year is the 110th year.
My goodness.
Continuous parade, the longest running, largest Santa Claus parade in the world. And anytime you want to be a celebrity clown, just give me a call.
Okay. And speaking of people contacting you, what's the best way for people to reach you?
Probably through my website, rossmorton.com, or ross@rossmorton.com. That's probably the best way.
Okay, well, thanks for your time, Ross.
Pleasure as always.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?